You know this man, Warren Buffett, the Oracle of Omaha. He's an absolute legend in the financial world. But what if I told you that the entire philosophy that made him, well, him, wasn't actually his to begin with?
Let's really think about this for a second. For over half a century, while markets were booming and then completely crashing, Buffett just kept winning. It almost feels like magic, right? How in the world did he see what everyone else missed over and over again? Did he have a crystal ball? Some kind of secret algorithm? Nope. The real answer is so much better.
You see, the secret to Buffett's incredible success wasn't something he was born with. It was a powerful, rock-solid set of principles he learned from one man. A man who not only survived the Great Depression, but went on to quietly lay the entire foundation for modern investing.
And that man was Benjamin Graham. Now, his name might not be as famous as Buffett's these days, but in the world of finance, he's basically the founding father, the teacher. He literally wrote the book on value investing, and in doing so, he shaped the mind of the world's greatest investor.
And listen, Graham wasn't just some academic preaching from an ivory tower. Oh no, he was in the trenches. After making it through the crash of 1929, his firm, Graham Newman, went on to consistently beat the market for 2 straight decades. You can see it right here. He proved his theories with cold, hard results.
Buffett himself said it best. He said Graham's ideas didn't just work, they actually became more valuable during the tough times, during those financial storms. While other, more fashionable theories were crumbling all around, Graham's philosophy just stood there solid as a rock.
So, what was this philosophy all about? Well, his first core principle is a big one. Graham believed that most people lose money simply because they don't even know what game they're actually playing. He drew a really clear, hard line in the sand between 2 totally different things, investing and speculating.
So here's the difference. An investor, in Graham's view, analyzes the actual business. They're thinking like they're buying a piece of a company. They're looking for safety first and then a decent profit. A speculator? They're just betting on which way the price is going to move. They couldn't care less about the business. All they see is the ticker symbol going up or down.
And we see this play out all the time, don't we? Just think about the dot-com bubble, when companies with zero profits lost 95% of their value, or day traders jumping in and out of stocks. There's this classic story about traders who frantically bought up a stock, TMCO, because they confused its ticker with the actual hot IPO for Ticketmaster, which was TMCS. That right there? That's pure speculation.
Okay, so if the market is just filled with all these emotional speculators, how is an intelligent investor supposed to act? To answer that, Graham came up with maybe one of the most brilliant allegories in the history of finance. He wants you to meet your imaginary business partner, Mr. Market.
I want you to picture this. You co-own a business with a guy named Mr. Market. Now, he's a great partner most of the time, but he has these really severe mood swings. And every single day, without fail, he shows up and offers to either buy your share of the business from you or sell you his share.
On his good days, he's absolutely euphoric. He's convinced the future is paved with gold, and he'll offer you a ridiculously high price for your shares, way, way more than they're actually worth. This is the market during a bubble, just completely high on optimism. But then, on his bad days, he is just gripped by pure terror. He's absolutely convinced the business is going to fail, and he'll offer to sell you his entire stake for pennies on the dollar. This is the market during a crash, completely drowning in fear and pessimism. And here is the whole lesson. You are totally free to just ignore Mr. Market. You can tell him to get lost. But his crazy mood swings create opportunity. You can sell to him when he's feeling euphoric and buy from him when he's depressed. The single biggest mistake you can make is letting his emotions become your emotions. His job is just to quote you a price. Your job is to decide if that price makes any sense. He is there to serve you, not to guide you.
So if these lessons are really hitting home for you, do me a favor and make sure you're subscribed so you don't miss what's coming next. But don't you dare go anywhere, because we're about to talk about Graham's single most important rule for protecting your money from total disaster.
Graham was smart enough to know that the future is always uncertain. He knew that even the smartest person on earth is going to make mistakes. So he came up with this incredibly powerful concept to protect you from yourself and from the madness of Mr. Market. He called it the margin of safety. The idea is it's so simple, but it's completely profound. A margin of safety just means you only buy something when its market price is way, way below what you think its real underlying value is. That gap, that difference between the price and the value, that's your cushion.
It's your buffer against bad luck or a bad call on your part.
So how do you actually do it? Well, first, you do your homework. You figure out what a business is actually worth. Let's just say it's $1 per share. Then, and this is Graham's advice, you shop for stocks like you're shopping for groceries, not for perfume. You're focused on the price. You only pull the trigger when the price tag is a total bargain. Say 60 cents for that $1 of value. That 40-cent discount, that is your margin of safety.
And why is this so unbelievably critical? Because avoiding the big loss is the most important part of this whole game. Just look at this number. If you take a 95% loss on an investment, which so many people did in the dot-com bust, you need a jaw-dropping 1,900% gain just to get back to where you started. A margin of safety is your best defense against that kind of irreversible catastrophe.
Okay, now I know what a skeptic might be thinking. Sure, this all sounds great and it worked for Graham, but does it work for anyone else? Well, years later, Warren Buffett himself answered that exact question in a famous speech where he revealed the incredible success of this little group he called the super investors of Graham and Dodsville.
What Buffett did was present the actual audited records of several investors who had all learned directly from Ben Graham. Now, these guys all worked on their own, they bought different stocks, they had totally different personalities, and yet, look at this. Guys like Walter Schloss and Charlie Munger, they all absolutely crushed the market averages over decades. This was not a coincidence.
Buffett drove the point home with this perfect analogy. He said, imagine there's a national coin flipping contest and it produces 215 winners. But what if 40 of them all came from the same tiny town? You wouldn't just say, oh, they're lucky. No way. You'd get on a plane and go to that town to find out what in the world they were doing differently. These super investors all came from the same intellectual town, the one built by Ben Graham.
And that really leaves us with one final crucial question. Graham taught us that the market is just a pendulum, always swinging back and forth between wild optimism and total despair. But it can never, ever predict the future. So knowing that, are you going to let yourself get swung around by its every move? Or are you going to focus on the only thing that actually matters, the real value of the business?
Because in the end, the secret that Warren Buffett learned from Benjamin Graham wasn't some hot stock tip. It was a philosophy. It was a mindset built on a foundation of emotional discipline, unwavering patience, and the simple, powerful idea that a stock isn't just a blinking symbol on a screen, it's a piece of a real business.
If you found this journey valuable, help us out by hitting that like button. And I'd love to know, what was your single biggest takeaway from Graham's philosophy? Drop it in the comments below. And of course, make sure to subscribe for more money lessons by history. Thanks for watching.